SpaceX IPO'd last week, Kevin. Were you tracking this?
A little bit. I can't say it was top of my list of things to track last week, given everything going on in healthcare world. But tell me about it, Martin.
Well, Matt Levine likes to say that a 20% IPO pop is the perfect IPO. And so
Mm.
I just want to give a big shout out to Goldman Sachs and the other bankers here on
They nailed it.
they nailed it. Uh,
Why is 20% the perfect IPO in Levine's world?
yeah. So if it's goes up, if it pops more than 20%, then you've left
You left
money
too
on
much.
the
Yeah, yeah.
table.
Yep.
If it goes
Fair.
up less than 20%, the IPO investors didn't get the pop that they were hoping for. And so
All right.
20% is ideal, and like pretty hard to do much better than 19.22%.
They got it right on the dot. What is their market cap right now? Do you know?
It's above 2 trillion. So
That's impressive. I've seen the picture going around social media that the difference, if your net worth is $1, your net worth is closer to the number two person than the number two is to Elon right now.
yeah, yeah,
Good for Elon.
pretty crazy. Pretty crazy. I was going to ask you if you thought this had any indications on any healthcare IPOs. I feel like no. I feel like SpaceX, Anthropic, OpenAI, there's no good comp that is getting ready to go public from that list. So, like that makes sense with those lists. Anthropic or OpenAI, I think, is the closest thing to a healthcare IPO that we're going to get this summer.
Yeah, I don't know that I can think of like what the specific read through is. I'd be curious what the bankers are hearing on the public markets, but I can imagine if anything, this is taking up all the oxygen. So there's not much time for other convos, but
Yeah.
it'll be fun to keep an eye on.
Well, we're going to kick off the Grand Roundup this morning. We have a packed show for you today. Super excited. We have some last minute breaking news from Matt Holt. He's making a move on a different rev cycle company than he was a few months ago. We're going to talk a little bit about Hawaii, and man, what an interesting jumping off point to fee for service versus value based care, integrated care delivery, provider consolidation, struggling regional blues, which I saw you were posting about this morning. I mean, really, this story has everything a healthcare nerd would want.
Mm-hmm.
There's the PwC story. So 9%, looking at 9% medical trend increase for 2027, and a comeback. Maybe it's comeback season for managed care. And then we have two great guests. We've got John Kao, Chairman and CEO of Alignment Healthcare. Always a good interview. I'm hoping for some classic vintage John Kao quotes today. And then Hashim Zikri from Council Health. But before that, we've got to give a shout out to our sponsor. Over to you, Kevin.
Today's show is brought to you by our sponsor, Ursa Health. Ursa is analytics company behind value-based care providers and enablers across primary and specialty care, including CityBlock, Gentiva, and Wellvana. Next week, we're going to be hosting Ursa and Atlas Oncology Partners to dive into specialty value-based care and how their model works there. I've had the chance to look through some of the slides. I think it's going to be an awesome conversation. So join us live if you can. If you can't make it live, you should register anyways. We'll share out recording, summary write-up with everyone who signs up. Learn more, register at luma.com/HTN-Ursa-Atlas.
It's going to be great. I am so fascinated at how these specialty value-based care contracts work, and it's going to be interesting to hear from the Atlas Oncology folks on it.
As we're going to get into with the Hawaii conversation, as you're already teeing up, there is a lot to making these conversations work well, be a win-win, work over time. So yes, it'll be awesome convo. Looking forward to that.
So we had some breaking news this morning right before we got started, and that was Matt Holt is back in the news. Ensemble Healthcare Partners, the Axios and Bloombergs of the world are reporting they are narrowing in on a acquisition deal, $12 billion for Ensemble. I think it'd be helpful to get a bit of a rewind, Kevin. Who's Matt Holt and what's he doing poking around Ensemble?
Matt Holt, formerly New Mountain Capital, was known for playbook in the space, acquiring platform asset, rolling that up with 4 or 5 other entities, growing that business, doing relatively well by doing so. Kind of new, fresh approach to private equity and healthcare. There's some interesting conversations out there um, about that approach and how it's been different from kind of traditional private equity approaches in healthcare, how it's involved more investment in these companies and grown them seemingly successfully. He left, what was it, fall? It was leading into JP Morgan. So late last year, to essentially mount a bid that would spin out a handful of new Mountain Capital's portfolio companies into this new entity Thoreau that he was creating. It was a really interesting idea to see play out, right? Thoreau, though, ultimately, and it became public as New Mountain Capital shared a letter with its shareholders that they were right on the door of a deal. Thoreau had to secure debt financing to get it done. And it seems like the credit markets over that period of time where they're trying to do that didn't materialize. New Mountain Capital came out this spring and said, "Hey, we're moving on from this transaction. We got to have our businesses focus on their day to day." Because it was such a big deal, it became a bit of a distraction within the broader industry. So Thoreau went quiet after that for a bit. If you look at Matt Holt's LinkedIn profile, he is currently listed as the president of the Paris Review. So I was sitting here thinking Thoreau is dead. It took a left turn, and Matt Holt's now off doing something else and not trying to rethink healthcare platforms. But alas, they were at work in the background um, and announced. I saw one report said that he signed the deal over the weekend. I saw a couple other reports that they're nearing the deal. Either way, I think my general takeaway is it's happening most likely. Apollo, I think, is backing Thoreau with the capital behind the deal, so it seems like they've secured the financing for it. And Ensemble's been on an interesting trajectory of its own, right? Bon Secours Mercy has been a key partner in launching Ensemble back, what, I think like a decade ago, 2014-ish. Private equity got involved, and then Warburg and Berkshire, I think, are the two private equity backed groups that are selling to Thoreau as part of this deal now. They tried taking Ensemble public back in, well, this was pre them. They invested in Ensemble in 2022 at around a $5 billion valuation. So getting out, whatever amount they get out at a $12 billion valuation seems like a nice win for them. They were trying to go public or M&A, do a dual path process in 2025 at 13 billion. And they tried going public once before in 2021. Ensemble had filed an S1 at that point in time. I'll probably be spending this afternoon going back and reading through that because it's always interesting to see the context of how these businesses change over time and the narrative they're telling. I had the chance to sit with listen in on their JP Morgan presentation in January from their CEO, and it does seem like the business has grown really nicely. If you go back to the S1 in 2021, they were talking about having, I think it was 21 billion of net patient revenue under management for health systems. That's up to 50 billion today, which gives some indication of how much they've grown and why the valuation has grown as it has. To me, I put this in our Slack this morning as I was thinking through the deal and going back to that January conversation that the CEO had with investors at JP Morgan. The tone of that conversation was very much AI is challenging and it's resulting in a lot of bot versus bot wars. And our solution at Ensemble is actually a very human centric, boots on the ground. We are helping our health systems with humans to figure out this RCM problem. And he had this quote of, he thinks a lot of systems are implementing AI point solutions. They think they're saving 2 cents on the dollar, but what they don't realize is they're actually losing 98 cents on the dollar because they're not focused on the overall picture. And I was like, I actually really appreciated hearing that story because we hear so much about the AI pitch and how it's going to save money and cure all ills facing healthcare administrative issues. So it's fascinating to me to see now Thoreau, which was like the very AI centric play, acquiring Ensemble as the kind of platform asset, which it presumably is going to bolt on a whole bunch of AI tools to grow that thing moving forward. So it'll be interesting to watch how this plays out. I would expect we're going to see a whole bunch more acquisitions that are tucked into Ensemble moving forward. But big news this morning. What was your take after that monologue I just went on for a few minutes?
I think the original Thoreau deal, it was Datavant, Swoop, Machinify, Smarter Technologies, and Office Ally. And I
Yes.
think it was about 30 some, maybe $32 billion.
Yep.
This is 12. If you assume that he's, the ambitions are similar, and this is just the anchor tenant for Thoreau, that's a lot of room to go out and make some interesting acquisitions. And yeah, I think as you were just talking, I thought back to the Long Humans Investor Manifesto, I guess you would have to call it,
The one that
from
Thrive did last week?
yeah,
Yeah. Yep.
and thinking about this narrative which they're applying to accounting, but it feels obvious to me that you could apply it to healthcare and to rev cycle and to all of these other things, which is that, yeah, there's going to be humans in the mix. There's going to be AI in the mix. There's going to be a lot of complexity, and we're going to have AI tackle AI shaped problems, ingesting lots of information, and humans tackling these sort of more human shaped problems. And it seems like a pretty compelling pitch to me. So that's exciting. I think it will be interesting to watch. It'll be interesting to watch how that narrative changes, and it'll be interesting. I'll keep my fingers crossed that the credit markets stay open and quiet for Matt. But yeah, I'm looking forward to watching this one.
The one other really interesting data point to me that it ties to, as you know, I went out to a Bridges keynote session on Thursday, and they were talking a lot about the payer-provider partnership, kind of hinting at this real-time claims adjudication state they seem to be moving towards. We've heard that from Optum with Optum Real. Everybody, if you own the transaction layer, apply AI to it, you should be able to make magic happen and poof, all the issues go away. And Ensemble CEO gave a really good anecdote at the JP Morgan presentation, which was he was talking about sepsis diagnoses. And he's like, historically, you didn't require a culture for sepsis diagnosis. It's not part of the clinical requirements that, as I understand the guidelines, which is very little, as he was articulating them, is not usually required. A payer has started requiring that, and Ensemble has noticed that in the RCM workflow. And so providers who didn't used to do that now have to get that test done in order to diagnose for sepsis to bill for that from the payer. Sepsis, as we've seen in some articles, has been one of these areas where AI documentation has seemingly increased billing associated with it. His point was AI can do a really good job of predicting cases that might get audited by payers that might have issues, challenges that payers might provide. What it can't do is anticipate that a payer is all of a sudden going to say, hey, we now require a culture to do a diagnosis of sepsis, because it's unable to predict that moving forward, right? And his point was that's where AI falls flat, and where we actually need to do the human work to make sure that we are building these relationships between payers and providers and working through those friction points. And to me, it's a perfect example of where technology can only go so far in this space, right? I heard it at a Bridges session on Thursday too, where you get these payers and providers up on stage, and they're talking about this kind of frictionless flow of data, which, yes, that is a helpful step. But then they also talk about, well, this then allows us to define the rules of engagement so that we can work with each other. And historically, we haven't trusted each other, and that's the issue. And it's like, yeah, that is the issue. Defining the rules of engagement is the challenge, right? Who gets to define whether or not a culture is needed to diagnose sepsis? If the providers don't think it is, but the payer does, that's an issue, right? And I don't know how real-time data flows solve that problem. They don't, right? They are you need to go upstream to the actual relationship between the two. So anyways, I think it's fascinating to think about that example in the context of, if you're Matt Holt thinking about what you do with Ensemble and the assets that you roll into it, what problem are you trying to solve in building this transaction layer? And how do you effectively bring those assets together to solve what, in my estimation, isn't actually a data problem. It's a negotiation issue and a lack of trust between two counterparties that are fighting over the same pot of money.
I always get a little perplexed when I hear this pitch about how we're going to get payers and providers singing kumbaya and getting along in perfect harmony. That is like not what we want in the healthcare system. We want an adversarial relationship between those two groups because that's what allows the private market to function, right? Like the administrative cost is the cost of doing business for a adversarial negotiation driven process. If there isn't one, then and the payers are just saying, well, here are the rules and here we'll do the payments, there's sort of very little reason for them to exist at that point. Like I understand the instinct because when I've heard Matt Holt talk about the opportunity here in the past, he talks about all of this administrative spend that
Mhm.
AI should be able to vanish. I think that there's a philosophy of it's called Chesterton's fence. It's like before you get rid of a fence, you should know for certain why the fence was put up in the first place. And a reason why we have these sort of administrative systems is that for years we've been going back and forth in this battle between payers and providers, and there's some social utility to that we've decided on. Now, you can take that in a different direction. You can do all payer rate setting. A lot of countries do that, but that's a new set of rules. And so I and the long humans like thrive on this. I think that the complexity and administrative costs is good. And I think that you're going to need people and AI to help administer these sort of what are these fundamental disagreements for a very long time. Should we talk about Hawaii?
Let's do it. Similar conversation, very different lens to it, right?
I think that it's about time for us to do some on the ground journalism here in Hawaii,
I
Kevin.
was
I think
gonna
it's time.
say the same thing. Let's check out some primary care clinics in Honolulu. Doesn't sound terrible to me.
You talked about this at length in the Sunday newsletter, and I thought reading it yesterday, what a perfect encapsulation of so many themes that we just keep on going back to again and again and again. We've got a regional blue nonprofit who's financially struggling. We've got this really promising, like if someone was pitching me on the capitated payments to primary care providers, I'd be like, oh yeah, that's cool. That's gonna like change the game. And how that actually played out in terms of utilization of emergency and urgent care. And then we've got a proposed payvider integration, which is very of the moment right now, very much talked
Sure.
about. And so, what caught your eye about this story?
So I'm going to go back in time a little bit. So HMSA, which I told Martin before this, I'm going to butcher every time I try to say it. HMSA. A decade ago, so 2016, they embarked on this 3PC capitated model for primary care. At this time, I was working on Harkin, which was new primary care model with Iora in ACA exchange coverage. And it was one of these examples of a market where a Blues plan was moving to value-based care. And how cool is that they are actually able to get this up and off the ground and move along in that direction. And so going back in time, it was one of these hallmark examples of what value-based care can and should be. They got industry experts. Zeke Emanuel is part of the paper that they helped design the program at UPenn, I think. So you had the best and brightest designing this model, working on it. Fast forward, I had lost track of what the results of the model was. They had issued a paper in 2019 saying, early data, but not seeing a ton of meaningful success from the program. But I hadn't checked in on it in a while. So it was fascinating to see HMSA in the news over the past couple of weeks for moving away from this value-based care model towards a fee-for-service payment model. It got me digging. So I went back, and you can start to see in 2017, 2018 provider pushback in Hawaii against the value-based care model, right? And there's this one article I linked to in the newsletter that they essentially said this is going to make access worse. It's going to drive up ED utilization and urgent care utilization because you're not paying us enough under this value-based care model to make it worth our time. Docs are going to go into concierge care. It's going to be a bad outcome. That's essentially what seems like it's happened. Like HMSA came out and said, we're going back to fee for service because access hasn't improved, ED utilization is up, and urgent care utilization is up, despite the fact that we think we are investing more in primary care, which to me is an interesting dynamic in all of this because the practices have shifted their tone a little bit from that pushback of the VBC model in 2017 to hey, if we move back to fee for service from value based care, this is going to be a financial hit to our practices. There's a quote from one practice talking about how it's going to be a $50K loss for their practice moving from value based care back to fee for service, which it's kind of crazy to me how both sides of the argument have done a complete 180 over the last decade, right? You've got providers who hated it, now want to keep it. You've got the payer who was championing it, who's now like, we need to go back. So I find that fascinating. And that's even before we get into the payvider dynamic, you know?
Well, I wanna pause here on the fee for service VBC front. I don't know if I've shared with you my sort of Buddhist theory of healthcare, which is that like everyone is
Yeah.
unhappy. Human suffering is universal, and there is not a payment model that fixes people's unhappiness with the allocation of scarce resources in a healthcare system. It's just like I will bracket a quick anecdote in here and say when I was a teacher, we loved making new seating charts. And we would spend hours making new seating charts, and we were like, this is the seating chart. We're gonna put this kid next to this kid, and this is the seating chart that is gonna solve all of our problems. And it never worked, right? Like, because you were like, it's not about the seating chart and it's not about the financing model. Like, the financing model does push you towards certain outcomes, but the sort of root thing is that people are unhappy with the scarce allocation of healthcare dollars. The PCPs are unhappy because they're getting the short end of the stick. The patients are unhappy because they're not, they're paying more and they're getting less value. Like everyone's unhappy about it. And whether it's a capitated payment or fee for service payment, it doesn't change the sort of the nature of that unhappiness. I think that uh, the argument from the PCPs about it actually just needed to be more is one of those things that I would love to test. Like
Mhm.
if I was running an experiment, if I was, an advisor to Abe over at CMMI, I would say like, what is the actual payment amount that can get a PCP to sort of get them to play this role where they're keeping people from urgent and ER utilization. That's the thing that costs money. Like that is the
Mhm.
thing we are trying to design around. And I think that if you look at concierge medicine doctors, some of them I think are getting like 200, 400, 500 at the lower end of the spectrum. With that, like 20 to 40 bucks, okay, maybe that's not enough. And with a 2,000 person panel, you could very easily imagine working all day and all night fielding inbound calls of like, hey, I got this cough, or like, like a FaceTime with like, does this look infected? What is the right payment model? I think that for all of its sins, like fee for service, probably in a money constrained environment, fee for service is probably pretty darn good technology for allocating those resources, even if no one likes it.
Yeah, I mean, we're seeing various versions of this conversation play out in real time, right? Look at the maternity space where they're going from a bundled payment back to fee for service. Like, there clearly is an argument here. in this direction that we're seeing from a payer who was leading the charge on VBC models a decade ago. I don't think it negates the premise of VBC, but yeah, I some of the articles in Hawaii are pointing out how, and this is not surprising to anybody who follows these conversations, some of the PCPs have part of why there's an access issue is because some PCPs have moved into concierge practice already. Their patient panel shrinks significantly, but they're making $300 on average a patient. So those PCPs generally seem to be happier in that model. But from a systems perspective, that seems challenging to navigate when we're dealing with shortages of primary care providers. Perhaps NPs are an answer to that. Perhaps AI is an answer to that. Who knows, Martin? We could.
It's a very controversial and brave take
Yes.
to announce publicly, Kevin. You heard it here first, everyone. Kevin thinks. Just kidding. Not going to finish that sentence. Yeah, I think there's a big component to that. Another sort of thread, we're going to chat with the investors from Evidence in a couple weeks. They're VCs. One of the investors lives in France, and we were catching up. He was in DC the other day. We were catching up, and he's like, how come fee for service works just fine in France and it doesn't in the US? And I made like a dumb joke about how the French love taking vacations. I do think though that there is something to that, right? Like I think American doctors want to make more money. And there's like we live in a society that handsomely rewards that, making more money. And so if you were making $20 per patient per month and you can go and make 300 per patient per month, like you're probably going to do that.
For sure. Yep. I don't have too much to add on motivations in France, but I might go to the payvider angle of this narrative because I think that is another fascinating element of this. That part of the reason why this move from HMSA got on my radar is because the governor in Hawaii started pushing back on this change. They had to delay the implementation of VBC to fee for service because they are embarking on this merger with Hawaii Pacific Health, which the entire premise of the merger is savings from value-based care. They talk about how they're going to drive $2 billion of savings by moving towards more global cap models, moving it from just PCPs to specialists. Like you can envision the theory of where those savings are being derived from in a payvider model. That was announced at the beginning of the year. It's gotten a lot of pushback locally, apparently, over the opacity of the deal. Not a lot of the terms are public. And there's some questions around, well, there were questions even before HMSA moved from VBC to fee-for-service around what that actually means, how it's going to drive cost savings, what it's going to look like for folks in the region. And it's really befuddling in the context of that, to see HMSA move from primary care, value-based care payments back to fee-for-service. Like it just doesn't compute to me. Beyond HMSA is struggling with their financials. As you mentioned, I put in Slack this morning, there's a Modern Healthcare article out, I think it was today, looking at finances for the 29-ish Blue Cross entities. HMSA, only 7 of them generated a positive operating margin in 2025. HMSA was not one of those 7. It wasn't one of the worst performing Blues plans, but it was not profitable on an operating basis in 2025 or 2024. It seems those issues, along with issues on Hawaii Pacific Health side, brought these two parties together, trying to work together to figure it out. I actually think that is a relatively good path forward of all of the potential paths forward, because I was also looking this weekend at it's Blue Cross Blue Shield of Alabama is engaged in a PR battle with a hospital that is closing because they are saying Blue Cross of Alabama isn't paying them enough. And Blue Cross of Alabama is like, listen, we're only 20% of revenue for them. What do you expect us to do? Like this is management issues inside this health system. But it's again back to this adversarial relationship between these two entities in a pot of money that I think we are seeing different flavors of this conversation over and over again. It's just not big enough right now for both of them. And we're seeing all of these kind of confusing actions that are taken on a one-off basis that result in stuff like this happening. And I don't know how we solve that, but it's happening across the board, you know?
Yeah, I mean, this would be the gentle pushback that I would give to Zeke a week later when we were saying maybe the system needs more money. And he said, no. Is that like, yeah, like this hospital's going out of business. This plan and this hospital in Hawaii are going and rushing into each other's arms. Kevin, I'm a little bit confused about how we're supposed to feel about integrated payviders recently. Are they evil and the root cause of all of the American healthcare problems, or are they a obvious alignment of incentives and actually good?
It depends. I like personally, I if you look at these situations and you think about yourselves in the shoes of an HMSA leader, I think it is a very logical direction to head. A model like this, a model like Kaiser, Devoted gets a lot of credit for what it's trying to build. Yes, if you look at the other side of it from the other side of the equation, you can there's acts in DC being written right now about breaking this up. Those acts are more targeted towards the larger conglomerates at the moment, but the theory of the case underlying it is the same. It's just a question of how at what scale, right? And I don't know. I personally, this seems like a better path forward than the Alabama example I gave of you're watching one of these entities shut down because they can't keep their finances afloat, because if they do shut down and you start playing out the ripple effects of what happens after that, I don't think anybody likes that scenario either. And so it's just a challenging environment. One of the most interesting pieces of this that is a comes across as a minor detail, I wrote about it towards the tail end of my note in the newsletter. HMSA noted that part of what is driving the move to go back to fee for service payments is that Hawaii, as a state, is trying to make sure it gets its fair share of federal dollars, and that in order to do so, it needs more higher fidelity claims data, which is easier to get in a fee for service system when you are documenting everything because you are billing for that versus in a value based care system where it becomes a little bit more unclear, like what's actually underlying this data. And if that's the case, it's a headwind that I had not fully thought through yet for value-based care writ large. When the federal government is saying, "Hey, we are paying less," they have more scrutiny on states to justify how much they are spending. And because you've gone into value-based care arrangements where you're not necessarily documenting everything the exact same way you have historically, which by the way is one of the perks of these sorts of arrangements or going into concierge medicine or whatever it may be, right? Like you don't have to document as much. But when you're trying to claw every dollar you can out of the federal government, you need that documentation when the federal government's like, we want it. So
They
I
want to
thought that
know,
was a
yeah, they want to know what they're paying for.
right.
And it is a real tension. And it is interesting. I was having a conversation with someone recently about how similar to how the billing and financing system doesn't like magically solve all of the problems. The fraud is like another one of these sort of universal human constants. And like the vector of fraud looks different in a fee for service and a value-based care environment. Like there is not magically no fraud if you do fee for service and you can have more billing data. It just becomes billing fraud instead of other flavors of fraud.
Mhm.
So I don't know. That's one to watch, though. That is one to watch on whether there is a sort of change in how people like to approach these things based on the fraud posture of the federal government.
Yep. In general, I think this Hawaii scenario on the whole is if you are trying to pick up a case study on what's happening in American healthcare, I don't know that there's a better case study than this to like go back over the last 10 years, think about what led to the value-based care conversation as it was at the time, think about what has transpired in the period in between, think about where HMSA is today and the financial issues it has and why it has those, what is leading to this proposed tie-up between it and Hawaii Pacific Health, and think about how it plays out from here. I can't imagine that, given all of this uncertainty in the market, that it's a particularly high likelihood that the payvider tie-up happens. Maybe it still does. I'm not close enough on the ground to know how that happens, but like, does VBC still play a key role in that? How are they playing primary care providers? All of these questions are worth thinking through how it plays out and what happens in Hawaii moving forward. And yes,
And
maybe we'll have to do an on-site visit this fall to see get an update on what's going on.
sounds like a plan to me. Well, the other piece of news that was making the rounds was medical cost trend. So PwC, the good folks at PwC did some analysis of, surveyed some payers, and we are looking at the largest single year medical trend increase in the Affordable Care Act era going into 2027. So we got that to hang our hats on.
Can we appreciate the irony for a second of how we jump from a conversation about how payers and providers can't stay afloat at the moment to, okay, we are now jumping to the highest medical cost trend environment. And note, this is commercial. They break out group and individual now as markets, but it's commercially oriented analysis. The highest we've seen in 18 years.
Yeah.
It's what a wild time to be in American healthcare.
I thought that the breakdown was really helpful. I mean, there was a lot of what you would expect, behavioral health, pharma, GLP-1s. There was some talk about the No Surprises Act, which is obviously something we have covered here. But the top one, the thing that they led with, that PwC led with, was AI, which I felt like it was sort of vindication for a narrative that you and I have been pretty attached to, which is that providers are really kicking the butts of payers when it comes to the bot wars right now.
Yeah, and I mean, I think payers are catching up too, right? But yes, I like that clearly is what has driven a lot of this, and I think it's entirely logical that it's played out this way. Like going back to the Abridge session on Thursday, Abridge has Shiv has made the point in a couple different interviews publicly that as a provider in this country, you don't get paid for the care that you deliver. You get paid for the care that you document. And these tools allow you to document and understand what payers require you to document, by the way, right? Better than you've ever been able to before. And if that's the case, I think we should absolutely expect the first implication of this to be providers are going to use that to document what they were doing and get paid more for what they're doing. Back to your the France versus US analogy, like I don't think that should be all that surprising writ large, despite I get that there's the narrative of, there's so much waste in American healthcare and AI can reduce that. It's like, yeah, I understand that. But also just like think about how this is going to be implemented in health systems care delivery orgs. You're going to document what you're doing and you're going to get paid more for that. And we see that over and over again. Go back to the Ensemble sepsis story that he was telling at JP Morgan. You can see it in real time happening, and it is interesting to see that PwC is noting this as a key cost driver, to your point.
Yeah. If you go back, you can sort of, and you describe a LLM, the sort of obvious first implication of it is like, man, we are going to get so good at optimizing billing practices with this thing. Right? Like it is going to analyze the rules. It is going to tell us in this, sort of text-based interface, here's what you missed. Here's what you're allowed to, per the rules, upcode. And like I said, like we're going to hit an equilibrium eventually, but PwC clearly thinks that is not happening in 2027.
Yes.
So
And the interesting question in that, going back to this payer provider tension negotiating dynamic, is where and how does that settle out over time in my mind, because that's the underlying issue here, right? Providers have essentially found an advantage in capturing more of the pot of money. It's driving trend in that direction, and I we got to see how this plays out over time. We know that payers are starting to look at this more and trying to do things to counteract that. We see companies like a Bridge coming to the table and saying, "Hey, we can bring all of you together and solve this in a win-win scenario." There is an opportunity there that does make sense, if payers and providers could just work more closely together, which might lead to payviders being a logical outcome of all of this, of all things. No?
Yeah. I think it's an interesting we'll talk about some of the levers that payers have. It feels like a sort of funny moment because we have medical cost trends, up 9% predicted next year. The consensus in Washington is, I think, still, hospitals are getting their fair share of blame, but it
Mhm.
really feels like between what's going on with Wiser, what is going on with, recent like commentary from the AMA and other legislators, is that the consensus view is that payers shouldn't be using AI to do things like do utilization management or prior authorization. And this strikes me as a sort of interesting asymmetry where the it is easy for us to say providers should be getting every dollar that they can collect based on the AI tools that we've got. But payers who no one likes and everyone loves to hate shouldn't be using AI to protect your premium dollars and make sure that you're not being overbuilt. I don't know what to make
Mhm.
of that. I don't know what you make of that, Kevin, but it does seem like it does seem to me like we're pushing out that equilibrium even further with moves like this.
Yep. Can in my mind, there's a couple of things to break down in it. One is, uh, I think there is a flavor of corporate versus humans in it, right? Like when you hear about the arguments against payers, it is always the argument about against the big bad greedy national big payers that are out there. It's corporate interest in healthcare. We don't want that, and I think those two things get lumped together. That is one element of the argument, and then to me, the other element of the argument is um, denying care is always a losing proposition to begin with, as we have seen with the Wiser model and what folks think of prior auths in the House Appropriations Committee. Applying AI to denying care is is never going to be a winning political proposition. It is going to be the easiest thing to say, no, we're not going to allow that. And I think that is going to be an evergreen statement. I we were just putting in Slack this morning the NPR article from the weekend about how digital health companies, Verta, Vita, and others, because they're starting to work with employers and titrate access to GLP-1s, that can be perceived by employees as denying them access to the GLP-1 that they want. Guess who is going to lose the PR battle when that narrative starts to emerge? The companies that are denying access to people the care that they want. And I just applying AI to do that more efficiently is just it's a really easy. I think if you're in DC trying to lobby, pick somebody on the Hill, it's a really easy thing to say, hey, like this is your talking point, don't
I
allow
think that that is absolutely true. It does not feel to me like the payer lobby is putting up much of a fight. Like from a communications perspective, the rejoinder to that I would say, again, I don't, have any besides being someone who pays premiums and also, um like a taxpayer. I don't have like a specific horse in this race, but I would say that like, hey, these providers are using these tools to optimize figuring out how much we can raise your premium every year, or how much we can and like there does seem to be a counterpoint that you should at least
For sure.
try to be making. Like I don't know.
Yeah. It's a broader economic counterpoint, but I mean you can see it in this data, right?
Yeah.
This is the counterpoint right here. Look what's happening to your premiums. They're unaffordable not because of us payers, where we are actually trying to manage care, but um, because of what's happening with things like AI and GLP-1s and mental health access. That is what's driving up costs per this PwC report. It's going to be a hard conversation. Back to the Zeke conversation we had last week. It is again indicative to me that we are going to see a major piece of healthcare legislation in the next couple of election cycles, because it's just, this path is not sustainable right now.
Yeah. It also makes me grieve a little bit for the Wiser model, which was such a good idea. Like, no one needs skin substitute. No one needs the volume of skin substitutes that are currently being prescribed in original Medicare.
For sure. To be fair, we are preemptively grieving a little bit, right? Like it's not officially done yet,
True.
but as you said, a unanimous vote in the appropriations committee is not, it's not a good
Not a
sign,
good
right?
sign.
How many people are in the appropriations committee?
63.
Yeah. Yeah. Getting 63 people to agree unanimously on something in DC these days seems pretty incredible. That is a feat that Wiser accomplished, I suppose.
I'm gonna put on my comms advisory hat again, and like instead of calling it Wiser, my pitch for CMMI is that they called it the Improve the Medicare Trust Fund Solvency and Relieve Seniors of Burdensome Premium Increases model.
What does that spell out?
Nothing, IRM, TF, like
Not going to work then, Martin.
I know.
It's gotta be punchy.
But here's my argument. Like, what if it was less punchy and no one knew what it was and it sounded mind-numbingly boring? Do you think it would get a vote in the House of Propes, or do you think everyone would just say, oh, that sounds neutral to good?
Maybe. I think if there are local articles in Seattle about how it's denying care for folks who need it for their back pain, it's a tough one to overcome. I don't know.
Should we talk about the other drivers of, so not just the AI and not just the prior auth of it all? Hospital services inflation was on the list, hit a high in February 2026. Boy, not great. They're talking about provider consolidation as a driver, and does not seem like we're reversing that trend anytime soon.
Nope. I am curious though if we look back on this as the beginning of we've talked about this idea of your like industries are either in bundling or unbundling phases. If we start to look back at this as the end of a bundling era in healthcare, I would think that if that is true, it is going to be true because of a piece of legislation that has not passed yet that makes unbundling more attractive. But the theory of the case would seem to be teed up really well that could get passed, and all of a sudden, what once incentivized bundling in the industry is now incentivizing an unbundling period. Given time and time again, we see results like this from this bundling activity.
Another driver was behavioral health utilization, and this was a volume, not unit cost story. We're hearing this in LifeStance, in Talkspace, UHS, as part of their rationale of Talkspace. Like, behavioral health utilization is up. It is a good thing that more people are getting the sort of the help that they need, and we are going to have to pay for it. And the way that we pay for that, right, is through these insurance premiums. And so the pivot to focus on payer covered services for behavioral health has been, that's something that we've seen across the digital virtual behavioral health models, as well as LifeStance, which is in person and as well as virtual. And yeah, we're seeing it in the data that like people are using their behavioral health services more, and it's going to cost us.
Yes.
No Surprises Act, man. We've talked about this a lot. recently, and yeah, it's like payers are losing, and that translates to premium dollar increases.
I was surprised to see this one make it on a list like PwC. Like we've been talking about this for a bit as something that is just clearly driving costs, and that may or may not be an issue depending on what side of the equation you're on. Clearly, to payers, it's a major issue. To providers, it feels like getting paid what I think they feel like they deserve to have been getting paid all along, potentially. Either way, the result is costs are clearly going up. But I wouldn't have expected to see it be as prominently highlighted in a PwC report like this on overall kind of market costs and what's driving growth in that. And I'm interested to keep an eye on what happens to NSA as it gets more and more attention as one of these key cost drivers. Like, I don't think it's a program that's going anywhere at this point, as we've discussed, given it's got its own kind of cottage industry that's now become entrenched around it. We're not getting rid of something like that. But what does it become moving forward? How does it change over time? Is there anything that can be done to get these costs back in check? Because the last time we heard an opinion out of DC on what this thing was doing, it was like, well, it's working kind of as intended. No issues here. Let's move on. Right. I think there was a quote from Cassidy, like, providers are getting paid what they should. Like, there's a process that they're winning. Okay. This is the result, right? It's now getting highlighted in an article like this on cost trends. And I think that's, we'll see how it plays out.
Last point before and I'm going to tee you up for a question on whether this is bullish for ICRA after this. But the last point that they brought up was pharmacy trend still outpacing medical trend. They obviously talked about GLP-1s, but there's other factors there, including cell and gene therapies. This has been a theme that you and I have talked about. We're in an age of miraculous drugs, GLP-1s included, and those miraculous drugs cost money, and we're seeing it in the medical and pharmacy trend.
Yeah, I couldn't help but juxtapose seeing this result and them talk about GLP-1s with Trilliant's analysis last week of GLP-1s. And as there are more indications for GLP-1s, sleep apnea, things like that, they kind of pose the question of what's that going to do for cost and affordability if GLP-1s stay at the prices that they are, with, I think, the implied answer being it's going to be problematic for affordability. All signs continue to point to this being an ongoing issue that has not been resolved yet, right? As we get these miracle cures that come down the pipe that more and more folks are taking, and pharmaceutical companies expect an ROI on developing those drugs, you can see why this PwC article, they said they expect healthcare costs to be, was it 9 trillion by 2035? Was that the year?
Yeah.
I mean, that's insane. We've got, I think, a good portion of the population saying the 5 trillion we have today needs to go down. And then you've got a group like PwC saying, well, it's actually going to basically double over the next decade. Isn't that mind-blowing?
It is. And like, what do we expect? If we're not going to say no at any point, then that is what we get. And I go back to my saying, like, I think maybe we need to spend more, because if we don't, we have to tell people no.
Zeke, help, Zeke,
I need you.
We need his policy recommendation on how to do better, because you can see the freight train is off the tracks, and you can see it and stuff like that.
Yeah, and it has a lot of momentum. Without an intervention, then prices go up. It becomes a larger part of our economy, and that's that. Where I want to end before we transition here, one of the points that PwC made was employers can't sustain the current level of benefits. Mm-hmm. People love making this prediction. People are always saying we're right around the corner of employers not being able to stomach the cost of benefits. Hasn't been true up till this point. I'm curious if you think that this time is different, this moment is different. Is this bullish for ICRAs?
Maybe. It's hard to say, right? Like I have a feeling that we will be having a very similar conversation 20 years from now. Employers can't afford healthcare benefits. How are they going to figure it out? Costs are increasing. This is an issue. I feel like that is going to be an evergreen conversation, no matter what the specific solution is here. At the same time, it does seem like ICRA will be a part of what happens next in this country in American healthcare. Again, we heard Zeke talking on Monday about this idea of 2032 election might come with a major policy proposal that's something like single risk pool for government sponsored insurance and employer risk pool. And there's going to be a bifurcation in that, I would think, of employers that can afford to continue offering insurance to their employees and employers that can't. And something like ICRA is going to be playing a key role for somehow for those employers that want to opt out of offering insurance coverage given these sorts of dynamics. And so my general take is it'll evolve. I do think it is a net tailwind for ICRA. I think ICRA 20 years from now is going to play a big part of coverage for employers who want something slightly different than they can offer today. Maybe it'll be called ICRA at that point in time. Maybe it'll be something else. And I would also guess that it'll follow a similar trajectory of we saw of high deductible health plans 20, 30 years ago now, where they were presented originally as, consumer directed healthcare. It's going to be this amazing thing that's going to change how healthcare is delivered in this country. And, there are laws of gravity that prevent that from happening in the ways that our best and brightest might want it to writ large, which is the industry for you.
It is the way that it goes. I feel like we've covered commercial, we've covered individual. I think it's time to talk a little bit about Medicare and the managed care sector more broadly. What the heck is going on with Clover, Kevin?
Clover, how much was their stock up this week?
Well, in the last month, it's up like 37%. So
yeah. They are on a tear. A big part of it was this week they filed 8K coming on the heels of that court case about how CMS is calculating stars, which Clover won, although CMS, I think, can still appeal. And so it's not technically 100% done yet. But nonetheless, the 8K suggested that CMS has told Clover to refile its PPO bid at 4.5 stars following the court win. So assuming that win holds, it implies that Clover's PPO plan, which I think is like 97% of its membership, will now be at 4 stars moving forward. That means that Clover gets meaningful financial win, and their stock's up 20% as a result of that. The Clover retail community has taken this as a huge win. It is all over social media. I don't know if you follow that much, Martin, but on X, Reddit, they are very excited about Clover's prospects and how it is mirroring the SPAC narrative that came out once upon a time.
To the moon, one might say.
Yes.
Yeah, so this was like a sort of fun update because it hit all of the sort of regulatory and public markets hit points that we sort of love to read about. It's coming at an interesting time. It feels like market sentiment has been a little bit back and forth on managed care this year. Obviously, going into the year, it's been a rough couple of years for most of the plans. And it's nice to see some wins. Absolutely. I'm going to flip over to the alignment chart. So up 24% over the last month. Like, it feels like managed care is really making a comeback, at least. And maybe it's not. We shouldn't call it a comeback. It's already been back, and the market is just finally now appreciating it. But this seems to me like two of the smaller upstarts. It's funny to call them smaller upstarts, like companies of these sizes, but really making great inroads in the and having a great turnaround. So it's exciting. I think it feels like managed care might be back.
Yep. 2026 has been off to a hot start for the industry. Excited to talk to John about all the various machinations of how he views the world.
Yeah, well, that's actually the perfect intro. So, we're really excited to welcome John Kao back to HTN. We're going to get his insights on managed care sentiment shift, ex California expansion, and what it's like negotiating with health systems in this current moment. How are you today?
Good morning. Doing great.
Good to
Welcome
see you
to
again,
the show,
John.
John.
Good to see you again, Kevin. Good to be with you, Martin.
Yeah, good to meet you. Kevin, I'll hand it over to you for the first question.
Yeah, John, I'd be curious. We were just highlighting stock chart changes and machinations in the public markets. The last 6 months in the industry seem like a uncertain time in a broader uncertain macro environment. It seems like the last few years in general have been a particularly interesting time to be running a Medicare Advantage plan, given all the changes the industry has had to digest. In general, it feels like 2026 is providing firmer footing. The industry is starting to wrap its arms around what utilization environment looks like going forward, V28. At the same time, we're seeing stock prices go down 10% a week, up 20% the next week. We've got lawsuits that are changing how stars might be calculated for the industry moving forward. Like, uncertainty still seems to be a key theme of the day, but the tide also starts to feel like it's coming back in at the moment. And I'd be curious, as a plan leader, how do those two things feel for you? How does that tension kind of between uncertainty, the tide feeling like it's coming back in, how does that show up in your day to day? How do you feel like sentiment is in the space versus where it was 6 months ago? Are we moving in the right direction? I'll leave that open-ended question for you to take.
Yeah, no, I've said this before. Never bet against Medicare Advantage. Meaning, I've seen this for the last 35 years. It's the same thing. The last time this happened was really, I think, in 2010, 2011, where the ACA had effectively a 15% reduction to MA rates. And they referred to that as normalization. They got to phase that in over the 5 years. Everybody freaked out. And it lasted about a year. And then everything normalized. And then if you look at, say Humana's stock price from 2011 to today, I mean, it's just gone straight up. And I think you have these, kind of pricing corrections every 10 years or so. And V28 was the most recent one. And the plans, they have to adjust. And the beauty of the business is you get to readjust every single year. You can normalize, you want to grow, you want to do margins, et cetera. And I think the sector's back. I think MA is going to be, I don't know, 65, maybe I've even heard 70% of overall market share of seniors in the next 5-10 years. It's just the value proposition is just too high. And so what they did with V28 actually was a good thing. It kind of reset the sector. They brought program integrity back, which I just applaud this administration for, kind of looking at MA guys in the lens of. I'll share with you. I think if I'm CMS, I'm looking at this from a P&L view. What I mean by that is, okay, look at the P&L. Start at the top of the food chain. Look at the payers. What are the payers doing right and wrong? How are they gamifying the system? Well, it was coding, and it was prior auth. Those two things I think are the two hammer points on the plans to make sure the plans have program integrity. Next, they zero in on Trump RX. They're going after the drugs, right? Kind of normalizing margins there. Then they're going after all the fraud, waste, and abuse that you're reading about in a couple of different markets. So in particular, why I like this particular administration is not just Minneapolis and LA, it's also South Florida. So it's just like, it's not a red or blue thing. It's like, let's just clean the whole system up. And I think, with what, 2-3% ish type margins, maybe 4 or 5 in some companies in terms of the large MCOs, I think we're still feeling good about long-term margins, 5-6% in the sector. And I think it's I think 3 years is enough time to be in the barrel, which is what the plans have gone through. I think they're going to come out of it. Some will do better than others. And I think the folks that have an understanding of care delivery, clinical based care for MA are gonna do better than others. Does that help, Kev?
Oh yeah.
One of the things we hear from you when you're, on earnings calls and presentations is that expansion outside of California is going to be easier for you all because of the IPA infrastructure. For those of us who are not maybe as familiar as the California markets and IPAs, can you give us a sense for what it's like in California today, how the IPAs are working, and what that looks like elsewhere in the country?
Yeah, IPAs in California are a good thing. Really, IPAs are provider partners of ours, and they were organized, I don't know, 40 years ago, really just to help individual practices, individual practice association, IPA, and for contracting purposes. And so they had all these large payers coming in, and so they kind of aggregated a lot of the individual docs for contracting purposes, and they've evolved different kinds of management service competencies over the years, or MSO capabilities over the years. And so some do better than others in terms of star gap closures, for example, risk adjustment gap closures, working with the plans on utilization management, et cetera. So on a net basis, we have very good working relationships with the IPAs. They deserve a margin for the work they do, and everybody's happy for the benefit of that beneficiary. Ex-California, before I do ex-California, and so what we did with a lot of the IPAs over the past couple of years is we did something that's a bit uncommon in California. Is that in California, if you have a shared risk or a global cap agreement, just to throw a couple of acronyms at you, a division of financial responsibility is who does what, the plan versus the IPA. There's something else called the division of delegated responsibilities, or a DOTR. And so that means who actually does what operationally on a delegated basis. And historically, the IPAs have taken some form of capitation, either professional or global, but they really want to be delegated for utilization management. And some IPAs also want to pay certainly professional claims, okay? Which makes sense. If they're taking downside risk on the professional, they ought to have the et cetera. What didn't make sense to us was delegating to them the acute management, the management of the inpatient admission. We didn't think that they had enough of the data. They didn't have enough of the care model visibility that we have. And so over the past year, we worked with them to de-delegate them for the inpatient admission, the authorization. And all it really is just to determine whether a bill that's coming in from a hospital is an auth that's coming in, is it in an inpatient stay supported by medical records, or it's a 2 midnight rule admission that's really paid at an observation rate. And on average, an inpatient auth and claim is kind of 23-ish thousand per admission, which is close to 100% of Medicare. And then an observation stay is about 3,500. So obviously a big difference. And so we worked with them, we de-delegated them for that. Frankly, none of them really cared, but they started caring now because we're surplusing more. We surplused more. And so they're like, oh, wait a second, what else can you guys help us with? And so we surplus on these acute risk pools because our admissions management is so good. And we've been able to do that with great NPS scores and great stars. And so each one of them are getting bigger and bigger bonus checks. So the whole point is having an operational infrastructure that supports that was important to us because ex-California, we're taking all the risk. Typically, there isn't an IPA. And the closest thing you have to an IPA ex-California is what I would call a clinically integrated network, which is the same concept owned by the large health systems, right? These big health systems, these integrated delivery networks have aggregated both employed doctors and contracted doctors in the community under an umbrella for contracting purposes against the plans. The problem with the CINs is they don't have the management services infrastructure. They don't understand it well enough to optimize closing stars gaps, risk adjustment gaps, helping with utilization management, et cetera. And then oftentimes you have health systems that are still kind of trying to feed the beast, if you will, in terms of moving admissions into the hospital. And so we've had to develop our MSO competencies for all the professional risk, all of the institutional risk, and all the inpatient risk. And what I'm most excited about is our flexibility to contract with providers kind of how they want. And then we can have back-end operational success irrespective of what kind of contract methodology we have. Global cap, we know what to do. We know how to ingest data. We know how to do automated reporting. We need to have that gives us the visibility and control. Shared risk, delegated, we know how to do that. Shared risk, de-delegated, we know how to do that. And then all of the set above is required for you to work with when you're directly contracting with an individual practitioner. You got to support that doctor. The whole idea of alignment is align with the doctor so everybody wins, including the hospital. Does that help? Does that make sense?
For sure. John, my last real job before I started writing a newsletter for a living was I was working for a health system CFO. And so you caught my attention Q1 earnings when you made the commentary around, health systems think they're being paid at 85, 86 cents on the dollar. We as an MA plan think we are paying them everything they earn. And I can see the differing positions on those. I'd be interested to hear, as you're having these conversations with health systems out in the market, thinking about their clinically integrated networks, going to market with those health systems, how do you bridge the gap between those two positions and figure out how to work jointly together? And what I presume is win-win type scenarios across the system and payer.
Yeah, I'll answer the first question first, and then get into the what we're talking to with the health systems right now. What I said was that when I speak with health system CEOs and CFOs, literally 100%, and we're talking maybe an N of a dozen, are saying the same thing, that UMA plans are paying us 86% of what we get in original Medicare. Okay, and so I started that when you hear every single one say the same thing, it tells me it's a brilliant PR campaign more so than anything else. I mean, it's just brilliant. I mean, and blame the plan. And there's a few high-profile plans out there that have high denial rates that are making the rest of this the plans look a lot worse than they actually are. But what I said was, let's look at the numerators and the denominators. What's the denominator that you're talking about? It's traditional Medicare. Well, you're basically getting everything you want when you submit a bill for traditional Medicare. There's no editing at all. And in fact, CMS wanted to pilot something called the WISER program. And that got such political pushback. It was unbelievable. And all it was saying, look, let's make sure that the codes that you're submitting are in fact accurate and that you're not upcoding. Gee, does that sound familiar? I mean, so so then I started asking these guys, I go, well, wait a second, like what percentage of your auths and claims do you submit to the plans? What would you guess the proportion of those auths are inpatient admissions, auths versus an observation stay, 2 midnight rule admission? Well, It's like 100% is an inpatient, right? I mean, so the plans now through their they're not denying care. They're just making a determination based on medical records. Is it an observation stay or an inpatient stay? It's kind of that simple. And when you kind of do the math, it's about 85, 86%. So in other words, the plans are actually paying the hospitals what they deserve to be contractually paid. They may not like it because they want 100% of all their admissions, whether they're observations or not. And the way you get around that is basically you have to deal with them up front in the contracting, just have some predefined rates, that makes everybody happy around an observation stay. Having said that, the plans are still talking to us because there's a couple plans they really just don't like. A lot of the big guys, they just don't like dealing with them because of a lot of these claim edit issues and frankly denial issues. And so they want alternatives. And what they notice about us, particularly the ones that are approaching us, are the ones that are over capacity. So they're like at 120% of their acute debts, right? And so they're coming to us and they're saying, look, you guys are pretty good at managing admissions per thousand, right? And so like last year, we were at 142 acute admissions per thousand. And, CMS would say, original Medicare member is close to 250. So we're doing really well. And so they go, well, if you can reduce the percentage of our admissions for seniors down because of your care model, that allows us to free up more capacity for our commercial members that we're getting paid a lot more. And so we go, yeah, no, that makes total sense. And then you work out a contract where they also gain both short-term and long-term with that strategy. In other words, you're moving market share into their system. Their system now is, typically in their geographies, 50 to 60% of all healthcare spend. It's just the acute hospital, all the ambulatory, and then they have the professional specialty. Like it's 50 to 60%, if not even a little bit more of all spend. And there, as you guys pointed out on the last call, it's kind of their turn in the barrel. The plans got, last 2.5 years was under a lot of scrutiny, and pharma under PBMs are a lot of scrutiny, post-acute, fraud, waste, and abuse. I think they're going down that P&L and looking at, well, where's the real trend and where's the real money? And so as the health systems are feeling that pressure, they're looking for alternatives to manage their cost structure. And one of the ways is to lower the amount of admissions for seniors per se. And of course, if a senior needs to go to the hospital, they're going to the hospital. That's not the point. It's just if you can manage the patients at home and drive down admissions and make the hospital win financially with a contract, and then allow them to have more capacity on the commercial side, everybody wins. And it's clinically driven. And I think that's what the hospitals are seeing with us. And the degree of engagement we have had with their clinically integrated network, the doctors are the key. The doctors are the key to everything, has been different in the last year and a half than I've seen in the past. They just, and I think it's because the hospitals realize they've got ACA pressure, they've got Medicaid pressure, and so they need different ways to think about kind of a population health approach to managing their members and their patients.
John, I feel like it's never enough time with you. We're at time. Thank you so much for your insights today, and we're already looking forward to having you back.
All right, guys. Take care. Thanks for having me on.
Appreciate you, John. Good seeing you.
Take care, guys.
the idea that a hospital would go and say, "Hey, like help us get more commercial." I mean, it's such a unique insight, and I feel like every time I am like, "Oh, it's like a really good job of aligning incentives," I feel like I'm doing like a promo for Alignment Health. It's like align, but
Yeah,
that's what it is, right? Like the hospital
for
would
sure.
like to see more commercial folks and less MA folks. So, like,
For
if you
sure.
could do that, that would be great.
Yep. Every time I hear John tell the story, like you see why they trade at a premium compared to MA writ large. And it's going to be fun to watch this growth outside of California, what these clinically integrated partnerships look like. Because yeah, the theory of the case is it seems spot on, and everything we hear from CMS leadership and what they're talking about, it does seem like the path forward, particularly the care delivery centric capabilities and whatnot. So it'll be fun to keep an eye on that. I want to have him back on to talk through the PPO HMO dynamics that came up a little bit on Goldman, because I think that'll be
Yeah.
interesting to get his take on at some point as well.
Yeah. Especially with Clover, continuing to go all
Yeah,
in on their PPO model.
for sure.
But before then, we have our next guest. So the LA Times recently published an op-ed from Hashim on regulating clinical AI. Ura just announced a recent partnership with Council Health, utilizing their clinical AI for their members. We're really excited to have him chat with us about those things and more. Good morning. I believe you're out in LA, so I think it's still morning.
I am out in LA and it is
Yeah.
morning, but I've lost my voice a little bit because I'm a lifelong Knicks fan. So that is, yeah.
There's a lot of that going around the HTN office, believe it or
Okay.
not.
Right.
So we absolutely empathize. I wanted to start a little bit with your LA Times piece and give us like, what is your sort of current view on how we're as a country and 50 states and the District of Columbia approaching regulating clinical AI? And then as a sort of follow-up to that, what should we be doing? What's your prescription?
Yeah. It's great to see you guys and thanks for having me on. What is currently happening is difficult to sum up in the time that we have because it's currently a pretty patchwork regulatory framework where it is, I think over the last year, every single state has offered some legislation around AI and some states have offered multiple. And what that legislation looks like ranges vastly from state to state. You have bills that have been introduced in places like New York and Colorado that would really limit the ability of AI to be patient facing in a lot of ways. And you have other states like the sandbox experiment that's going on in Utah, where AI is fully practicing medicine right now. And I think that the federal government has stepped back from regulating in a lot of ways currently to try to see what the states are doing and what the states have the potential to do. And they've created a pretty innovative environment where you have, a laboratories of democracy approach is the phrase that I use in that LA Times piece, where they're really observing what is happening in each of these states. I think that we believe the federal government can set a floor for what the practice of AI clinical care looks like. This is the minimum that every state needs to meet in order to participate in this. And then on a state-by-state basis, that experimentation can and should continue to happen because that's definitional to kind of US law is the state practice of medicine. And so in a really big picture sense, I think it starts with a floor set by the federal government and then states innovating either well on top of that or meeting that floor of here's what needs to happen.
Hashim, I'd be curious. That thought resonates with me very much. I look at the state of Utah and the pilot they have ongoing, and I look at that pilot and I'm like, I don't even know if that seems like the floor to me of where it should be, because like I was looking through the state provided an update on how that pilot's going and how many people are going through it, and all of it still seems to be reviewed by a human today. Like it's not yet AI doing the refills of prescriptions. They are seemingly thoughtfully testing this as they're rolling it out, which strikes me as a very thoughtful way to do this and address some of the issues that are coming up in the state, as I'm sure we've all seen here. But even like that seems like one step in the right direction, but not yet at the floor for where I'd imagine the federal government moves over time. I'd be curious, like how do you think about how we should be thinking about what the floor is and what the conversation is around how we collectively define that?
Great question. So I agree. I don't think that in Utah right now we're at the floor. And I think that in 2 to 3 years, we're going to look back on this as not being close to the eventual outcome of where AI can already be helping doctors and be helping us expand access to care. I think that there's a common perception that the federal government getting involved in any capacity, whether it's through the FDA, whether it's through CMS, whether it's through other entities within the federal government, would slow down some of this innovation. And I think actually putting a stamp to say, we are going to allow this when you meet XYZ would allow this to speed up faster. And I think once the federal government is able to help set that floor so that people who participate in Utah, you know, for example, this isn't illegal. I'm not going to go against the FDA coming out in 3 months saying, no, we're not allowing this. Once you set that, then I think you can start to have significantly faster and iterative intervention for something like you pointed out. Maybe it's prescription renewals and taking doctors out of the loop for that. Or maybe it's something more aggressive, like autonomously managing urinary tract infections, which essentially happens in other countries. Once that is set, once you're able to have some kind of framework for, okay, I now know the field that I'm playing on, I know the rules of this game, then I think that you can start to use the Utah framework that they've set out, which I think is a good one, to study this. I mean, the idea of progressing from a doctor in the loop to one-click care to autonomous care, using data to do so, having that data be publicly available, and producing good science and research off of this, I think that Utah path is actually a very good path.
It feels to me like you're in such a unique position. You're a doctor.
I am.
You're also the medical director for clinical research and policy at Ensemble Health. We're seeing some emerging fault lines, I think, between providers and the bots, if I'm being a little cute, on what should be allowed, what shouldn't be allowed. I'm curious if you're feeling any sort of ambivalence or dissonance about this, and more broadly, like, what should we think about as like a fundamentally doctor job and a fundamentally robot job, and what's your view on that?
Yeah, I mean, that is the ultimate question, right? That a lot of people are asking right now.
Small morning questions for you on this Monday morning.
Yeah, I mean, one thing that I obviously get asked that question a lot, and one thing that I think is important to frame that within is what currently happens. Right? I think a lot of times there's a comparison against an ideal version, and then there's a comparison to reality. So by that same framing, like I work clinically at UCLA. Is it a doctor job to get a patient a cup of water? I would vehemently say yes to that. But is it a doctor job to sit in front of an EMR constantly going through medication renewals for people who weren't able to access care and otherwise and end up in the emergency department? I think at Counsel, we are very, physician driven and physician aligned. Our CEO is a doctor. We have 4 or 5 practicing clinicians that work on the platform, or all of our doctors that work on the platform are obviously practicing clinicians, but that are in leadership positions at Counsel. And we are very much making an effort to align with the physician community to make sure that anything that we're doing is in the service of making doctors' jobs better. And I think that a lot of this AI that's happening can really allow doctors to be cute, practice at the top of their license, to, when I'm working clinically in the emergency department, not be spending my time renewing medications, to really fundamentally try to combat the supply and demand mismatch that we're seeing, that I know a lot of primary care doctors face as well, really redefining what that relationship can look like. And so I personally, and we as a company, don't see much of a split between what a job of a bot is and what a job of a doctor is, because as a company, we see those as so entwined.
One of the things that we've been paying attention to recently is the access model. As part of the access model, consumer wearables and everything that's going on in that space. Obviously, Aura is one of the leaders in that market, and they just announced a partnership with y'all as part of their latest product release, where as I understand it, they're going to have access to Counsel providers in the Aura app. Could you explain a little bit about that partnership, what's going on behind the scenes, how you guys are working with Aura, and how the experiences come together across both?
Yeah, I mean, a lot of work has gone into the experience, and to integrate this and to have this within Aura's amazing patient-facing app already has taken a ton of work from a lot of stakeholders on our team. I think that this is kind of a revolutionary experiment in healthcare. I think for a long time, we've been talking about the ability of wearable data to influence clinical decision-making and if it could do so. And this, as far as I know, is the first time that we're testing that hypothesis to see what we can do with it. I think right now, this week, for the first time, we will be rolling out to speak with Aura patients, and we are going to be able to take the biometric data that they provide us, ranging from heart rate variability to looking at, women's health, looking at menstrual cycles, looking at pregnancy or fertility tracking, and integrate that into our clinical decision-making. And I think this is something that patients have really felt the need for a long time. You hear stories about patients going to their doctor saying, I have X finding from my sleep last night. What can we do about that clinically? And doctors really not being able to take action on that. And on the flip end, you have this, now what problem of patients plugging that data into Claude, plugging that data into frontier AI models, and not being able to have any clinical action that follows that. And I think it's going to be pretty exciting to study rigorously what this can look like.
I'm curious. So I've heard from some folks. We interviewed Zeke Emanuel last week, and he wrote a book called Eat Your Ice Cream. He's sort of famously kind of anti-wearable. The concern we hear from some folks is that, ChatGPT, Claude, wearables, these are actually going to increase demand for healthcare services, that we're not going to sort of achieve any savings from this. Instead, we're just going to have a lot more utilization, perhaps more people showing up at the emergency room. I'm curious what your perspective on that is.
Yeah, I mean, I've spent a lot of time thinking about this from two different angles. Number one, I'm personally a big runner, and I run without any wearables, without a watch. I run, an hour a day without any information. So I relate to somebody who does not want to see that information, but I think that it's becoming a rare breed. On the other end, I'm a researcher, right? I'm a health services researcher, and what I study is unnecessary emergency department utilization. So I'm very interested in making sure that that's not the outcome of what this looks like. And I think about it in two ways. One, new technology allows us to completely rebend what the supply and demand curve looks like in a way that nothing else has. So the idea that we now have patients' data, if in an old world, I agree that the ability, not having any access with that data does present, what are you going to do? You're going to go to an emergency department. You're going to go to urgent care. You're going to, hammer your primary care doctor over my chart. But in a world like, where you have counsel, what you're able to do is communicate with a doctor at any point asynchronously in order to take action on that information. And so once you're addressing this at that point of access, and you're not just creating more information, but you're also creating more points of access, then I think that allows us to really study what this can look like and to potentially impact it, because you're changing what those access points look like. The second part that I think about is that in an old world where you did not have, any kind of AI informing what the interpretation of that data looked like, any kind of AI that allowed a doctor to spend more time face-to-face with the patient interpreting the data that they're bringing in, that data is potentially non-actionable. But I think we have the ability to create an entirely new realm of science. I don't think you can just say off the bat, oh, heart rate variability, looking at doesn't mean anything. We're just going to say no to taking in this new data before we even have it. I think you need to take that data in and then using AI, try to create an entirely new world of science to say, what does interpreting this look like with an entirely new framework?
I'd be curious. We've heard from CMS leadership the goal of implementing AI in a deflationary way. That's part of the thesis behind access. Martin articulated some of the concerns about AI being used in inflationary ways and driving up costs in the system. If you were bending the ear of CMI leadership, CMS leadership on how they can ensure that AI is used differently in healthcare, it has a deflationary effect. What would you be thinking about? How would you be prioritizing the conversation in current environment?
I think access is set up very well. I think that they have done a really strong job setting up access. And I think the pushback around prices is a signal of that. I mean, if you are getting pushback around prices, then that probably means that you are doing a very good job promoting companies that are trying to do this differently, which I think is the goal of access. I think that the way that we think about this internally is aligning with a lot of the things that Access already does. I think taking AI and making sure that payments that are coming out of it are outcomes-based payments, which is obviously part of the framework of Access. Another way to think about that is thinking about it in terms of time-based payments. So almost like a subscription model to an AI service, because the concern is in a fee-for-service world, this is endless utilization, right? And once you take the cost of care down to the cost of compute, any incentives will align to find somebody a way to spend that endlessly. So another way that we've been thinking about it internally is more along a subscription-based model that aligns with those outcome payments. So if I were speaking to CMMI leaders, I would applaud them for what they are currently doing with Access, because I think that is a very strong start. And then trying to think of ways together with companies that are really on the cutting edge of doing this, of seeing how we can also make it time-based.
This was super helpful. I'm really excited to see how all of this plays out and any more of your writing that you have. Really enjoyed the piece in the LA Times. If folks are interested in learning more, where can they follow you for more writing, more thoughts on this developing space, and all of that?
Yeah, well, our company is Council Health, and we have a website, and then I am on LinkedIn, and I'm trying to, start writing a little bit more there and posting, and so you can find me there.
Great. Well, we will include a link to that in the show notes. But thank you so much for your time today. We really appreciate it.
Thank you, guys. It was great to see you.
Chatting with you.
Great seeing you.
See you.
Bye.
I can read my appetite for, in the same way that the demand for clinical services seems to be somewhat unlimited, my appetite for thoughtful pieces on how we regulate this stuff is basically unlimited. I'm so fascinated by this the tension between what has happened with every technology in healthcare up to this point and the prospect of infinite abundant healthcare.
For sure. I mean, if that vision materializes, it would be amazing. And it's a big if, given, as you said, the history of how things tend to seem to play out in American healthcare. What I do know is it seems like a really good time to be a consultant advising organizations on how to navigate those questions and change in this dynamic period in which we live.
Kevin, it was right there for you to say it's a really great time to join Health Tech Nerds and hop in the Slack and review the daily brief where we're talking about all of this stuff. But it is also, I think, a good time to be a consultant. And if you are one of those consultants, subscribe and join at healthtechnerds.com. Have a good rest of your day, Kevin.
See you, Martin.